So, what happens when one of the biggest healthcare companies in the world just hits a wall? In a single day, a huge chunk of its value just vanished. We're going to break down what happened, diagnose the crisis, and then get into their really radical and honestly pretty risky plan to turn the whole ship around. It all kicked off with this one number. After UnitedHealth released their latest financial results, their stock price just cratered. We're talking a drop of nearly 20% in one day. For a company of this size, that's not just a red flag, it's a 5-alarm fire. So you gotta ask, right? What on earth could cause a market panic like that? Well, the answer was kind of buried deep inside their quarterly earnings report. And that's exactly where we're going next. Okay, so before we can talk about the cure, we've got to diagnose the pain. And in this case, the pain was a multi-billion-dollar problem. Now, for anyone who's not deep in the financial world, an earnings report is basically a company's public report card. It tells everybody, especially investors, how the business is actually doing. And let me tell you, looking at UnitedHealth's latest report card, oof, it was clear they were in some serious trouble. And boom, here it is. This is the number that totally spooked investors. A massive $1.6 billion charge against their earnings. You know, seeing that on a balance sheet is like finding a giant hole in the bottom of your boat. The big question became, where did this come from? And when you zoom in on the details here, you see it wasn't just one problem. It was more like a combination of punches. This breakdown shows the charge was mostly driven by two big things. First, the final cleanup costs from a huge cyber attack they suffered, and second, a massive amount of money set aside for restructuring, which is just a corporate way of saying they were exiting some businesses and cutting staff. But this wasn't just some accounting issue or a paper loss. The problem was way deeper. See, the company basically runs on two giant engines. There's UnitedHealthcare, the insurance business we all know, and then there's Optum, their health services side. And the report showed that both engines were sputtering. I mean, you can see the problem right here in black and white. For both of their main businesses, their operating margins, which is really just a fancy way of saying how much profit they make for every dollar that comes in, they just got crushed. They were making way less money, squeezed by rising medical costs on one side and cuts to government funding on the other. So you've basically got a perfect storm brewing here. Medical costs were skyrocketing, government funding was shrinking, they were still paying for that cyber attack, and they were trying to completely reorganize the company at the same time. It was a total mess. So, with their backs against the wall, what did management do? They didn't just come out and say, we'll do better. No, they unveiled this radical, two-part prescription for recovery. The company's CEO, Stephen Hemsley, basically told investors it was time for some serious soul-searching. He said they were going to make some really hard choices about what parts of the business to keep and what parts to just get rid of. And this is where things get really wild. Part one of their radical plan, instead of trying to grow, UnitedHealth announced that it is planning to lose up to 2.8 million members this year. Just let that sink in for a second. This isn't them failing. This is their actual strategy. Now, for an insurance company, it's totally backwards. The old playbook has always been simple. More members equals more money. But UnitedHealth is completely flipping the script. Their new number one priority is what they call margin recovery, profitability. Even if it means intentionally shrinking their customer base. You can think of it like strategic pruning. So how exactly do you pull off a strategic shrink? Well, their prescription has two main ingredients. First, they're aggressively raising prices on their insurance plans to actually match these higher medical costs. And second, they're just walking away from the less profitable government-sponsored plans to focus only on the business that's actually making them good money. But hold on, trimming the business is only part one of the plan. Part two? Well, that's where they're making a massive, massive bet on the future of healthcare technology. Yeah, you're seeing that right. They are pouring a mind-boggling $1.5 billion into technology and AI just this year. Let's be clear, this isn't some small side project. This is a core pillar of their entire turnaround strategy. And listen to what the CEO said about this. It's pretty telling. He says they don't just want to participate in the AI revolution in healthcare, they are planning to lead it. They see technology as the absolute key to becoming more efficient and giving customers a better experience. And they're not just throwing money at this and hoping something sticks. They expect a huge return on that investment, and they expect it fast. The company is projecting that by using all these new AI tools, they can slash their operating costs by nearly $1 billion this year alone. Okay, so you've got this wild plan, right? Shrink the company to save it while going all in on AI. The billion-dollar question is it going to work? Let's take a look at the prognosis. Well, this forecast table tells you everything you need to know about how confident management is. Look, even though they expect their total revenue to dip a little bit because they're losing customers, they're forecasting that their adjusted earnings per share, which is a really key measure of profit, will actually grow by more than 8%. If they pull that off, that is a huge turnaround. So let's just boil this all down. What's the big picture here? UnitedHealth is making a really high-stakes gamble. They're choosing profits over size. They're using AI as their secret weapon to slash costs, and they're betting that by getting smaller, they can actually get stronger and weather this storm of government funding cuts. And that just leaves us with this massive, critical question that really applies to the entire healthcare industry. As this giant company bets on shrinking itself to get financially healthier, it forces all of us to ask, what does this mean for that delicate and super important balance between a company's bottom line and a patient's ability to actually get affordable care? That's the big question we'll all be watching.